Welcome to the Grow Your Business and Grow Your Wealth podcast with Gary Helt. Gary is an expert in helping business owners put together a plan that will provide a better future for their businesses, themselves, and their families. On the podcast, Gary interviews other professionals who share his vision, and together they share secrets and strategies any business owner can use to build a better financial foundation for your business and your life.
Welcome back to the podcast. This week, my guest is Steve Selengut, and he's the founder of the Retirement Income Coach. Welcome, Steve.
Oh, good to be here, Gary. Good to be here.
So, Steve, what got you? You've been doing this for quite a number of years. What got you into the financial advising and wealth arena?
Well, mostly I was fortunate enough to be able to start out early in life as an investor with my own money. And even though I didn't get into managing other people's money until 1979, which really sounds like a long time ago, I'd already been managing money for about 9 years my own. And I'd had talks with people. I was very fortunate. I had a broker that was really more focused on me than on her own commissions. In those days, there were commissions. Mm-hmm. And what she helped me do was really learn more about stock market. And in the long run type of looking at charts to see where securities have been versus where the market has been, and to stick with companies of very high quality, not to take any real risks. So I developed a very risk-averse approach to investing back then. And I had a conversation with I was working in the pension investment department of a New York life insurance company, not New York Life, but a New York life company. And I was in the pension investment department, and we were traveling, I think, out to Denver or someplace like that to visit a client. They had defined contribution plans that they managed, and my job was with that. And I was using their portfolio as sort of a template for my own. And I asked him a question. I said, why do you have so much Boeing stock? You have millions of dollars in Boeing. It doesn't pay a big dividend. And there's so many other things. Why don't you take your profits and move along? And the guy said to me, he says, well, Steve, the reason we have so much Boeing stock is because Boeing's a big insurance client of ours, and they like us to own a lot of their stock. And then the light bulb went off. And from that point on, I played every round, every card, every stock I ever owned. I said one thing. It's not just the investment, it's a lot of politics in there too. And if it's up in price, it could be just because a huge company like Equitable is told that they have to own a lot of their stock. You might as well take your profits and move on to something else. From that point on, I became a trader. And that's not in the dirty word kind of day trading type thing. Mm-hmm. But I always set a target on a profit. And with common stocks, I set a target of 10%. And with Rita helping me identify dividend stocks at the time, I always found something else to invest it in, and I did the same thing. I'd buy them when they were down a little bit, as much as 10, 20%, and then I'd sell them as soon as I could make 10%. So by 1979, I was ready to say I didn't want to work for these guys anymore. I can do my own thing. And I had my dentist who was interested, and a restaurant friend of mine out in Long Island that said, yeah, they wouldn't mind if I handled a few thousand of their dollars. I said, okay, I'm going to quit and go into business. That's basically it.
Now, you continued doing this for a number of years, and recently have sold your business. Can you tell us kind of the philosophy behind what you were doing from an investment standpoint that made you so successful?
Well, it's kind of that idea of quality. there are really four things that I use to make sure, or really to minimize the risk. And I call these things the four great risk minimizers. Everything has to be a quality of a certain level. In the old days, Standard and Poor's had a monthly guide that send out that so I look for B plus or better rated dividend paying companies traded on the New York Stock Exchange. Those are my quality tests.
Mhm.
And then there's diversification, and then there's income protection. I never bought a security of any kind that didn't pay income. So and it saved me a lot of mistakes over the years, if you
Mhm.
think about it. Um, and um, and the fourth one, which even today, most people on Wall Street don't even think about, is profit taking. Like I said before, I target profit. Everything I own in a portfolio is for sale if I can get my target profit.
Gotcha. In in your book, you talk about income independence and the goal of that. Can you explain that to us?
Sure, sure. What I mean by income independence is that you have a growing stream of income. It grows quarterly, annually, and it's more than enough to pay your bills and be able to reinvest more so that you continue to grow your income. So that's independence to me. It's enough so that if you say, okay, I'm gonna go to Africa on a safari like I did last month, I'm gonna start putting aside money for 4 or 5 months excess money so that I can take care of that. So you've got enough extra. Unlike, um, well, we'll probably get into it later, but I'm sure you've heard of the 4% rule
Hmm.
for retirement, where advisors say you can expect to take 4% of your portfolio value every year. And that's a great plan. But the execution of it for most people is we're going to sell 4% of your portfolio to give you that income. Each month, we're going to sell some stuff and give you the money. Now, we're never going to have any cash on hand because A, income is not one of our requirements for buying securities. And B, we normally get you to drip your dividends anyway. So you're just buying more of the same shares. So when it comes to the end of the month, we have to pay you the $3,500. We have to sell something. And typically, what we sell are the ones that are down, not the ones that are up. We don't take profits. We sell the losers and deplete your capital in the process, by the way, when you lose money. So that's the big distinction. I focus on the income. I focus on the income. I grow the income. I, you know, I invest in income focused securities themselves as well. So,
So are you
so
saying
even
that with this, with your inside a retirement account or even outside of a retirement account, you're trying to invest your money in stocks and things like that that are going to be constantly generating this income that you can pull out without reducing, your capital, basically your principal?
um, I think I understand the question. What I'm doing is, and I guess there are two things that changed. My original focus when I first started this in '79 was all individual big board stocks.
Hmm.
And then as time went on, um, and I used to use individual bonds, believe it or not, individual bonds and things called Ginnie Maes for income and bond unit trusts for income. And of course, I was getting principal back with each of their payments each time. But that's what I did. And then about 20 years ago, I discovered closed end municipal bond funds. I had a client who wanted his whole portfolio to be municipals, and um, the trading costs associated with individual bonds, they're not commissions, but they're markups. And they're very illiquid types of securities, meaning you just can't go out and say, hey, I've got $7,000 where for this company, this bond from, St. Paul, Minnesota, I want to sell it tomorrow. Well, you got to find a buyer. And most buyers are looking for 50,000 at a time in the bond market. So if you're a small investor, you're really getting torn apart with a 2 or 3% markup on the buy in, on the sell. So when I discovered closed-end funds through mainly through these municipal bond closed-end funds, I mean, it was wow. I mean, I couldn't believe this thing. Here's a portfolio of municipal bonds, just like I used to have the portfolio of regular bonds in a unit trust or a Ginnie Mae full of government securities. Now I can get municipal bonds, literally hundreds of them, all with laddered maturities and everything like that, and paying monthly instead of semi-annually, or even, well, semi-annually is what bonds pay, and at yields much greater than an individual bond because of the way they make their investments. So I switched. Anybody, and the one guy did have municipal bonds in his portfolio and my own. And by that time, my portfolio had grown, management portfolio had grown to nearly $100 million by that time. So I had a lot of people who had tax-free income. And then after discovering that, then I discovered, well, I can also do bonds. I can also do preferred stocks. I can also do government securities. I can do any type of individual income security you can think of, mortgages, real estate, everything. I can do that in these managed multi-security funds um, that are actually the oldest fund type security that we can trade on the exchanges today. They've been around longer than mutual funds, and they've been a lot wrong, maybe 130 years longer than ETFs.
Right.
That's how long they've been around. And not many people know about them. I bet you if you took a show of hands right now from whoever's listening here of how many of you have ever heard of closed-end funds, there'd be a lot of hands. There wouldn't be a whole lot of hands in the air.
Right. Right.
So that's the difference. I use different type of securities, and I focus on income. And in Retirement Money Secrets, the book, I go through step by step how you select these things, how you make sure you're diversifying properly, what types of income you should expect, how wonderful market volatility is. How about that one?
Yeah.
Not many people would agree with me, but you thrive on knowing and investing. If you understand that there is a market cycle and it's there's nothing you can do about it, and you can prepare yourself. You prepare yourself in a high stock market and the same as a low interest rate market by not buying as much as you would in a down market, because you know it's going to go down or interest rates are going to go up. So you want to have room to add to it and still remain diversified so you can reduce your cost basis per share and increase your income. So there's a lot of things going on in a managed income portfolio.
So you mentioned the market cycle.
Yeah.
Can you explain what market cycle investment management means and what it is?
Sure. Well, understanding that, just looking at the stock market, I think most people would know that over the years, well, since 79, for example, we've had 4 major meltdowns. We've had the crash of 87, where it dropped 40% on October 19th. We had the dot-com bubble bursting around 2000, where the NASDAQ, the over-the-counter, we used to call it the over-the-counter market, the NASDAQ securities market, pretty much, the S&Ps gained in 99 through 2000 was pretty much occasioned by the growth of 12 or 15 high-tech stocks. That's what it amounted for. The actual breadth of the market during that period of time was negative. And so you saw this coming, but the 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 uh, the market always has cycles like this. It goes up and up and up, and it always, when it starts to get up to an all-time high like we had on January 3rd, 2022, all your radar has to change. Eventually this is going to stop. It always has. It always does. So you take your profits even more aggressively. Um, I try to take three profits a day, every day. The last couple of days, not so much, but but you, and I did that. And when the higher the market goes, the higher that profit is to take your top three profits. It can get as high as 7-8%. And when it's at an all-time high, I probably go in twice a day and take three, because I know that eventually it's going to end. Eventually it's going to go back down. And I know that with closed end funds, I still have a universe of 100 income focused, they're mostly bond funds, and another 100 stock market based closed end funds that are paying. Well, at the height of the market in 2021, they were all paying in the 6 to 7% range. That was the lowest any of them were paying. Today, the same securities, the exact same securities, most of them are paying the same distribution, but the distribution is now 11% or 12% because the prices have fallen so much.
Right. What in your book you also talk about that that income fuels the yacht and the market value or realized income. I mean, can you go
Oh,
in
right.
a
Yeah.
little bit?
Yeah. Income fuels the ego.
Right.
And I mean, market value fuels the ego, and income fuels the yacht. It's a pretty good expression because people tend to look at their bottom line. They look at their bottom line market value, and like right now, they're all pulling their hair out and saying, "Oh my God, what's going on?" And this, that, and the other thing. But if they look at the income that's being generated by their portfolio, it really hasn't changed. I haven't heard of any major company cutting or eliminating a dividend, for example. So even if your Exxon is down 25%, and I have no idea if it is or not, um, it's still paying the same income. And so, um, so the idea is if Exxon goes up, back up that 25%, it's still going to be paying you the same income. If it goes down 25%, you're still getting the same income. So my premise is go for the ones that give you the most income, because then when they go down and the income remains the same, at least you can pay the bills.
Mm-hmm.
You don't, because most investment programs, like we said before, the premise is you're going to sell securities each year to pay that 4% that you're going to take down your retirement portfolio each year. So if you were 27 months ago, income securities started getting pressured by interest rate expectations. The Fed was threatening to raise interest rates. They finally did, but for months before they actually did, the income sensitive securities were going down in price. 27 months we've had. For me, that's the interest rate cycle. The stock market followed it. It peaked in January 3rd, 22, and it's been down itself ever since. But not all the way down. It's down right now about 12%, 10%. Nasdaq's down 20%. But that's the cycle. The cycle went from the peak in January thereabouts, and all the way down now. It went down as much as 20%, I believe, but right now it's around 12, 10%. So all that market value was lost. So people who are taking from their portfolios to pay their 4%, of their portfolio. First of all, 4% is less than it was. So they may have to take 5 or 6% if they want to continue the income
Mm-hmm.
because their portfolios are not generating that kind of income. Whereas if you have an income producing portfolio, like the book explains with closed end funds, that portfolio's generating more income than you're spending. So you're reinvesting at lower prices. So every month, every quarter, your income is actually increasing. You can keep that 4% distribution. Okay. You can raise that distribution a little bit with the inflation that we've had in the since the pandemic,
Mm-hmm.
and still be spending less than you're making in distributions. I have there's a chart in the book. It talks about working capital growth versus the drawdown analysis.
Okay.
And if you look at, we're looking at a portfolio of 10 CEFs versus SPY and the bond BND, which is the bond index.
Okay.
And you're saying it's a 500,000 portfolio. And if you're taking 4%, that's like 20,000 or so a year. And the only one that's making more than 20,000 a year is the closed end funds, because the other ones are not the SPY only pays about a 2%,
Mm-hmm.
and the bond fund actually paid almost 4% when we started. This was from 2008 to 2022. At that time, we were about the same interest rates we are now, so it was paying about 4 or 5%. So it was enough. But as interest rates fell during the financial crisis and all that time, the bonds were paying less and less and less. So it too was depleting capital. So when you get to the end, the closed end funds, which were paying only, even if they're paying as low as 7% and reinvesting, they're still more than doubled in this period of time, where the SPY is down nearly more than $100,000, and the bonds is down about $100,000 because of the depletion in capital. So dealing with the market cycle and dealing with the realities of interest rates and all that stuff is part of the process of protecting yourself from when the market goes down, because you're not investing as much at highs in what other sector is high, and you're adding to more of them or owning more of them when prices are low. And you plan this in advance. Diversification means you don't want to have anything in your portfolio that it represents 5% of the portfolio. In my idea, in my own portfolio, it's less than 3%, for example. So if you're buying in a rally, you might take a 1% position or a 1.5% position max, because when it goes down, and the price goes down, you're going to be able to add to it, right? If you're right now, we're at a 27-month correction is a pretty long correction, longer than the financial crisis was.
Right.
Twice what the 1987 crash was. A little longer than the dot-com thing was. And of course, the pandemic correction lasted 2 months. So,
Right.
So it's a long time. So my thinking is right now, if you're looking at a type of investment, be it stocks or bonds or closed-end funds or ETFs, if you look around, you'll see that pretty much everything is down. And that's a time where you should be buying selectively. More than likely, over the next, of course, we do have an election coming up, which does throw a lot more uncertainty in there about what's going to happen, but still in all, rarely do we have rallies that last, or corrections that last much longer than this.
Okay. in your book, you talk about helping people, find and pick the different investments that are income generating. Um, can you talk about that, a little bit, and tell us more about the book and what you accomplished with the book.
Okay. Well, the book is really kind of an interesting format. It's like a conversation like we're having today, where I'm talking to a couple that my wife and I meet on vacation, and they reveal that they've had to sell, significant amount of securities to pay for this vacation. And I said, and I tried to talk to them about how we fund our vacations with the income we make on our investments. And they became interested in how we do this. So we go through the preliminaries of what we almost talked about before. How do you, first of all, what type of all securities, you got to determine the quality of what you're buying. And you've got to realize that what you really want in life is to be able to have your income pay for everything, just like your employment used to do. If you can get to the point where you're making as much on your investment portfolio as you were in your salary before you retired, I mean, that's nirvana, right? That's where
Right.
you would like to be. And you can do that. And you can do that if you start soon enough. I mean, you can't start at 63 and expect to have that in place by 68 unless you got a really, really big job. But but the idea is you have to identify quality securities. So the book takes you through a whole sequence of things that you look for, the history of their dividend payments, whether they raise them, whether they've gone down, how stable are they, the volatility issue. You want them to be volatile, but you want the price range to be consistent. We're talking about funds of securities, and funds of securities aren't going to have the trading range that an individual security does. You're not going to have hundreds of points difference.
Mhm.
In fact, there's a feature of closed-end funds that we really need to mention to understand it better. These are not, they trade like stocks, and they're a lot like stocks in the sense when you buy a stock, you don't really know what its book value is, right? You just know what its market value is.
Right.
And if it's a popular company like Amazon or Google or one of them, it's likely that their market value is going to be a whole lot more than their actual intrinsic book value because they're popular and it's supply and demand. Um, and most people buy and hold. So once they own the Microsoft, they're not going to sell it no matter what happens.
Right.
So, um, so that's the type of thing. Um, a closed-end fund is required to pay out 95% of its earnings. So if it receives dividends from all these stocks or interest from all these bonds, it can't keep it and build its market value or build its stock price with more assets. It has to pay it out 95%. That's after expenses, of course, and
Right.
they do have internal expenses. The investors don't ever pay those expenses, but still, that's why they have such a narrow trading range. You'll have a range in prices of these things from under $5, which I used to avoid by the plague, like the plague when I was dealing in individual securities, to you won't find many above the $30 level. You know, so think about it. You could have a, a stock market closed-end fund owning, let's say, 250 different stocks, which would include pretty much everyone you've ever heard of. All the Nasdaq, all the FANG stocks, the Facebook and all those Netflix and all the big ones, and all the Exxons and Chevrons and Eli Lilly's and all those great companies. And you're getting a portfolio that contains thousands of shares of each of them, and you can pay, maybe you're buying it for $15,
Hmm.
you know? So if you look at an example of professionals and advisors, and today a lot, big companies, big advisors trying to do that very same thing with what they call model portfolios,
Okay.
where they'll have 100 different stocks in your account, and you'll see that you have one share of Berkshire Hathaway and two shares of this one and 16 of that and 24 of this. Um, they have a model portfolio where if Berkshire Hathaway goes up, you know, 40%, you're only making a couple $100.
Right.
Because you don't own any of it. Whereas with the closed-end funds, you own these very same securities. You own a professionally managed portfolio. You own stock in a managed trust portfolio that owns them, and you have reasonable amounts. So even if it were somewhat of a model, it's not like they're trying to place they're not creating the model out of your investment portfolio. They're doing it out of the bulk portfolio. So it's a totally different type of thing, but that's what you're getting. And the same thing you're getting on the income side with, like I said, the municipal bonds before. You're going to get 300 or 400 different municipal bonds in one of these closed-end funds in a laddered position. So right now, where interest rates are killing everything not because they've gone up, they're not really above normal. They've been below normal for 12 years.
Mm-hmm.
They're not really above normal now. It's just that we got here a 500% rise in interest rates in a year. That's what's the problem. It's hard to adjust to that. But the as the securities mature in these fixed income funds, the bonds mature and they get their money back. That's not profit. They don't have to distribute that to their clients. That's not income. Okay, that's principal. And they can now buy securities for 5% when 2 years ago they couldn't buy anything for 2%.
Right.
So eventually the yields on these things are the amount they pay out, the 95% of earnings is actually going to go up along with the interest rates. So, and as a result of that, eventually the prices will go up as well. And that's exactly what happened after the financial crisis. Municipal bond closed-end funds went up faster than the S&P at that time.
Right. Dave, we've covered a lot of stuff,
I know.
and I know you could go on for hours with this. What have I not asked you that you wish I had?
Oh, let me see. We looked at models. We looked at, talked about it being the oldest. We did cover a lot of territory.
Mm-hmm.
I guess what we're looking at here is this. Mutual funds were established, and the selling point of mutual funds when they first came out, that it was a way. People got scared out of the market in the Depression in the 20s. Individual investors, particularly small investors like us, let's say, and we are small investors, even if we're talking seven figures, we're small investors
Right.
compared to the big guys. But small investors were afraid of the stock market after the Depression. So mutual funds came out. It was a way for the average guy to participate in the stock market without putting a lot of money into it. It was safety. It was a wide, diversified portfolio. And those were the principles that sold mutual funds and made them so great. And that carried over, and that's since then it's carried over to ETFs. Well, before those things even happened, those were the principles that created closed-end funds. So, and their safety, is doubted sometimes because, like a business would, like a company would, when companies go out and they want to add value, they build another factory, they do this and that. But these trusts, closed-end trusts, their job is to build income. They buy securities, and they, just like a company would borrow money to fund a building, they borrow money short term to purchase more securities to generate more income. And this is called leverage. And my argument in the book is that, the world runs on leverage. If people didn't borrow money, companies didn't borrow money, we'd all be still riding bikes to school and stuff riding bikes to work and stuff.
Right.
So that's one of the big differences. This vehicle is unique. It's not well known. It's not used in 401ks, and that's why most people have never heard of it, because its internal expenses are too high according to SEC regulations. Because to the SEC, 2% after low expenses is better than 8% after high expenses. They just don't get it, you know?
Right.
So I guess we're looking at a securities that's different, that people should learn about. And if they read Retirement Money Secrets, hopefully a light bulb will go off and they'll talk to their financial advisor and say, hey, I don't mind taking 4% out of my portfolio every year, but I want to make more than 4% in my portfolio every year.
Right. Understood. Steve, if people like what they hear, they want to find your book, they want to talk to you, how can they reach out to you?
The book is at Amazon. Just Google Amazon Retirement Money Secrets and it should pop right up. Throughout the book, I give links to my Facebook group and to my website, which is called, it's simple, it's theincomecoach.net. That's my
Okay.
the website for that, for my coaching business.
Okay.
And my phone number and contact information is there also.
Great. So just to recap that, name of the book is Retirement Money Secrets. It's on Amazon. Definitely a good read. And the incomecoach.net is Steve's website where you can find him. Steve, I really appreciate your time today and your wisdom.
Thank you. It was good talking with you. I've almost lost my voice.
Yeah. Appreciate your time. So this week, our guest was Steve Selengut, who's the founder of the Retirement Income Coach. I will see you guys next week.
49 faces looked to him in triumph. Over the last 12 months, they had each taken turns and promoted his business for a week at a time, driving over $987,342 in revenue. What if you had a network of 50 centers of influence who promoted your business every week for a year? Grab your copy of the #1 Amazon best-selling book, The Ultimate Guide to Growing Your Business with a Podcast, at 33% off the Amazon price by going to ultimatepodcastbook.com. Again, that website for 33% off the Amazon price is ultimatepodcastbook.com.